and welcome. If you're involved in the world of global commerce, you know that one thing matters above all else: making sure you get paid. Today, we are going to demystify a really important set of rules designed to do just that. We're talking about the Uniform Rules for Demand Guarantees, or as you'll hear me call it, URDG 758.
Let me ask you this. Have you ever been in a situation where you're dealing with a huge international contract and there's that little voice in the back of your head wondering, what if they don't pay? Or what if they don't finish the job? How can you be absolutely sure that a major financial promise will be kept if things go sideways? Well, that's a massive challenge in global business.
You see, the fundamental problem is risk. When you don't have a clear, universally understood set of rules, you're operating in a gray area. And that uncertainty, it's a recipe for disaster. It can lead to expensive legal fights, long payment delays, and sometimes even catastrophic financial losses, even when you've done everything by the book.
And that is precisely the problem that URDG 758 was created to solve. By the end of our time together today, you're going to understand exactly how these rules create a stable, predictable, and enforceable framework. You'll see how it gives you the confidence you need to manage these international guarantees.
So here's our roadmap for today. We've broken this down into 4 parts. First up, we'll talk about the promise of payment, what a demand guarantee actually is. Then we'll go from chaos to clarity, looking at the history behind these rules. After that, we'll cover putting rules into practice. And finally, the part everyone's waiting for, getting paid, the actual process.
All right, let's start at the very beginning with the foundational concept. What in the world is a demand guarantee?
Think of it like this. A demand guarantee is essentially an ironclad, irreversible promise, usually made by a bank. That promise is to pay a specific amount of money to someone, called the beneficiary. But, and this is the key part, they only pay if the beneficiary presents a demand for payment that perfectly follows the instructions laid out in the guarantee itself. It's a conditional safety net.
So, who are the players in this little drama? Well, there are 3 key roles. First, you have the applicant. This is usually the person or company that's doing the work or selling the goods. They're the ones who go to their bank and ask for the guarantee. Then you have the guarantor. That's the bank, the one making the promise. And finally, you have the beneficiary. This is the party that needs the financial security, the one who receives that promise of payment.
Now, what makes this whole system actually work so well? It really comes down to 2 incredibly powerful principles. The first is called independence, or autonomy. The second is its documentary nature. Honestly, these 2 ideas are the absolute bedrock of the entire URG system.
Let's really zero in on that independence principle because it is so important. What it means is that the guarantee lives in a completely separate universe from the business contract it's supporting. The bank, it doesn't care about the real-world dispute. It doesn't matter if the goods delivered were the wrong shade of blue or if a building project is 2 weeks behind schedule. The bank's only job is to look at the documents it receives. If those documents are correct according to the guarantee, the bank has to pay. It's that simple and it's that powerful.
So, these rules are pretty slick, but they didn't just appear out of thin air. There's a whole story behind them. A journey that took us from a really confusing and unreliable system to the clarity we have today.
For a long time, the lack of standard rules was a huge problem, leading to endless legal battles. The first real attempt to fix this was back in 1978 with something called URGC 325. And it was a total flop. The real game changer came in 1992 with URG 458, which was later improved and updated into the version we have today, URG 758, which came into effect in 2010.
Now, if you want to know the single biggest reason why the first set of rules failed and the second one succeeded, this is it. The old rules said the beneficiary had to legally prove the other party was in default. Think about that. Proving something in a court can take months, even years. It completely defeated the purpose of a quick payment guarantee. The new rules made a brilliant change. They said the beneficiary only has to state in writing what the breach was. That tiny shift from proving to stating was the key that unlocked the whole system and made it work.
Okay, that's the history lesson. So let's get practical. How do we actually use these rules in the real world? And how do they really make life easier for businesses? You might think that incorporating a whole international legal framework into your document would be complicated. Well, it's actually incredibly simple. To make all 35 articles of URDG 758 apply to your guarantee, all you have to do is include this one sentence. That's it. That one line pulls in a complete, balanced, and globally recognized set of rules. And the real-world benefit of this is just massive. Think about it. Instead of hiring teams of lawyers to argue for weeks over pages and pages of custom legal clauses, You just drop in that one sentence. This saves an enormous amount of time, it cuts down on legal bills, and it provides instant clarity for everyone involved, no matter what country they're in.
And the rules are even more helpful. Article 8 basically acts as a checklist for drafting a good, clear guarantee. It tells you to make sure you identify all the parties, you reference the business contract it's supporting, you clearly state the maximum amount in currency, and you set an expiry date. And check out that last point. If you forget to add an expiry date, the rules automatically set one for 3 years. That's a great safety feature to stop guarantees from just lingering out there forever.
Here's another way that URDG cuts down on confusion. Imagine you have a seller in Germany and a buyer in Japan, using a bank in Switzerland. If there's a dispute, whose laws do you follow? It could get very messy, very fast. Well, Article 34 solves this. It says that unless you decide otherwise, the law that governs the guarantee is the law of the place where the bank's issuing branch is physically located. No arguments, no confusion. And all of this brings us to the most important question of all, right? How do you actually get paid? Let's walk through the exact claim process and the all-important timeline.
The process is designed to be really straightforward. First, the beneficiary presents their demand for payment. Along with it, they have to include a critical document called a supporting statement. Then, the guarantor bank examines those documents to see if they comply with the guarantee's terms. And based only on that examination, the bank does one of two things. It pays, or it sends one and only one notice of rejection. Now, let's talk more about that supporting statement because you cannot forget this. It is a mandatory, non-negotiable part of any claim under URDG 758. It's a simple written document that indicates how the other party, the applicant, has failed to live up to their end of the bargain. And it's so important that it's required even if the guarantee has vague wording like payable on simple demand. If you want to get rid of this requirement, you have to write it out explicitly in the guarantee.
So, once a claim is submitted, how long does the bank get to make a decision? In the old days, the rule was a fuzzy, reasonable time, which could mean anything. URDG 758 gets rid of that. It sets a hard deadline, and that deadline is 5. A maximum of 5 business days from the day after the claim is presented. This simple rule creates total certainty and stops banks from dragging their feet. The rules for rejection are also incredibly strict, and this is fantastic for beneficiaries. If a bank decides not to pay, it has to send a single notice of refusal. That notice must list every single problem, every single discrepancy they found with the documents. If they miss the 5-day deadline, or if they forget to list a discrepancy in that one notice, they lose the right to use that as an excuse later. This is called the preclusion rule, and it basically means the bank could be forced to pay the claim anyway, even if there were errors. They get one shot to get it right.
Okay, let's just quickly recap the absolute must-knows from today. First, independence. The guarantee is a world of its own, separate from the main contract. Second, documentary compliance. Decisions are based only on what the papers say, not the real-world facts. Third, the supporting statement. It's a mandatory part of any claim. And fourth, the 5-day rule. There's a fixed, predictable timeline for the bank to examine a claim.
So this leaves us with a big, thought-provoking question. We've seen how successful these rules are at creating a stable and predictable system that works for everybody. So, should we take the next logical step? Should the use of URDG 758 become mandatory for all international trade guarantees?
I'd genuinely love to know what you think about that. Is it a good idea? Are there downsides? Let me know your perspective in the comment section below.
And of course, if this helped you get a clearer picture of URDG 758, hitting that like button would be amazing. And be sure to subscribe for more deep dives into the mechanics of international trade.
Thank you so much for your time and attention today.